Hey, we get a lot of questions about the rent-to-own investing strategy, maybe even specifically in Canada, how it works. And we've done a lot of these in the Ontario area. We've done them ourselves. I think the first one we did was probably 17 or 18 years ago now. And then we started working with investors and really kind of guiding them through that same process of how to implement the rent-to-own investing strategy. And we stopped counting when we got to about 1,800 of these properties. That's no exaggeration. We were at about 1,800 properties between ourselves and the investors that we had been working with, and we stopped counting. We lost track of the number. So I can tell you that the amount of experience that we have doing these is vast, and we've seen all sorts of different circumstances and arrangements and all sorts of different stuff. But the key here is really what we're trying to do with the rent-to-own strategy is we're trying to cater to the top 20% of the rental market, and we're trying to bridge the gap between them renting and home ownership for them. And that's really where it comes in. And the benefit to you as an investor is that you're typically able to get a higher cash flow number on the property because they're not looking to just rent the property. This is really an ownership structure to them, or a plan to get them into ownership. And because of that, there's typically going to be a higher payment involved, and that higher payment would usually mean higher cash flow to you. So that's one of the benefits to it. And there's different ways to structure, but our kind of favorite way to structure this is we like to arrange the future purchase price because they're going to be able to buy out the property at a future date. We like to arrange that up front, and we use historical appreciation numbers. That time we sometimes used 5%, 6%, 7%. Long-term average amongst the area that we were investing in is about 6.7, 6.9%. So we kind of were in that range as well. So let me back up for a second here. So we're talking about the numbers, but the way the rent-to-own strategy works is that you're basically buying a property and then you're offering it to someone on a rent-to-own or what's called a lease option. And they're essentially leasing the property, and then they also have the option to buy that property at a future date. So typically it's a 1, 2, or 3 year term, depending on the way you structure it. And they can buy that property anytime within that 1, 2, or 3 year term at a predetermined price. And like we just spoke about, we're agreeing to that price upfront today. So that's the way the rent-to-own works. So there's really two documents involved when the way we structured it is a lease and then the option to purchase agreement. So that's how this works. So the other benefit to us as an investor is our downside's protected because we're establishing the future purchase price now that we know what the profit numbers are ahead of time. So we're kind of locking in our profit that way. Now there is a downside to that. If we do hit a market like we did see, in recent years, where the market really takes off and we were seeing, outrageous appreciation numbers of 10, 20%, a year or higher even, well, then you're actually limiting your upside too in that circumstance. So there are circumstances where you could be offering it at a 5 or 6 or 7% yearly appreciation number, and if the price goes up higher, those tenants are able to buy the property at a bit of a discount from you. So something to be aware of when you're thinking about rent-to-own.
Hey, it's Anthony Molinaro from the Your Life, Your Term show, and I've got some exciting news. On Saturday, April 12th, we're hosting our biggest and most in-depth Your Life, Your Terms event yet in Mississauga, Ontario, and space is filling up fast. This is your chance to join us for a transformational day packed with powerful insights, strategies, and connections to help you live life on your terms. We'll be covering the biggest real estate opportunities, what's happening with the Canadian and global economy, how to protect and grow your wealth with Bitcoin and hard assets, and how to use marketing strategies and disruptive technologies to build freedom and income for yourself. But here's the deal. Tickets are going up the closer we get to the event, and with the early flood of registrations, we'll likely be hitting capacity. If you want to guarantee your seat and save some money, register now before it's too late. And remember, if you're a Rockstar Inner Circle member, your tickets are completely free for yourself and your guests. Head over to yourlifeyourtermsevent.com and secure your spot today. You don't want to miss this one. That's yourlifeyourtermsevent.com.
In our opinion, there's a good and bad side to really every strategy. So there's different things to think about. Now, here's some other stuff that we've noticed when we did a number of these rent-to-owns is that typically the average tenant you're going to get into a rent-to-own property is a little bit higher quality than the average tenant you would in a typical rental property. And often that's because they're viewing the property as their own. They're viewing it as their home because ultimately they're looking at buying the property. Now we've seen all sorts of things. We've seen people completely renovate basements. They've put in full fences around the yard and redone driveways and even added an addition to the home in a rent-to-own scenario. So we've seen really extreme cases like that. And then we've had situations where the tenant was no longer able to make the financial commitment. They had to move on to another property. So that happens as well. So we've seen both sides of the spectrum, but typically the average quality and the average experience for the tenant is going to be just a little bit higher than maybe a typical rental property. And that's a good thing for the investor. Now, the good thing for the tenant is that the way it works for them is part of their monthly rent every month actually gets applied towards the down payment of the purchase price. So if they're paying $3,000 a month, and I'm just picking a number out of thin air, maybe there's $300, $400, $500 of that is actually going back to them in credits. And those credits are applied when they're able to purchase the property at the end of that rent-to-own term. So this is like a forced savings plan for them. So that's a benefit to them. It also allows them to get into the property they want today. And they can start living in there with their family or treating it like their own property. And any upgrades that they make, just like the ones we were speaking about, they get the benefit of the value of those upgrades. We don't change the price at the end of the day because we've set the price beforehand, so they get the benefit of that. And they get the security of knowing what they're going to have to do to then qualify for that mortgage and buy that property afterwards. And we'll often set them up with one of our mortgage brokers or advise them to go to their bank or any mortgage broker or however they want to do it to get the guidance that they're going to need to see if they're going to be able to purchase this property at the end of the term. And that's before they even get in there, right? We advise them, hey, go check it out. Make sure this is going to work for you. We want to set them up for success, okay? And there's one other aspect to this as well, and it helps both people, okay? There is a down payment involved, and the down payment goes towards the purchase price of the property when they eventually buy it. It's typically a non-refundable down payment from the tenant to the homeowner or the investor, and that's a plus side for the investor because it acts as a little bit more of an insurance policy, so that you know that they're financially committed to the home as well. So they're emotionally committed to the home because they view it as their own home. And there's a financial commitment because they're giving a down payment. Typically it's maybe 2 or 3% of the purchase price. I mean, it will vary all over the place. And that goes directly towards the purchase price at the end of the day, so the tenants get full credit for that down payment. So it kind of works out for everyone that way. It's nice for investors because it can be a way to get into real estate investing without having to think about maybe all the things that might be involved in owning a property over 5, 10, 20 years, right? We go into every rent-to-own investment that we've done like we might have to own the property for 5, 10, or 20 years. We never know what's going to happen. But very often it's a nice way for investors to dip their toe in the water. And they're able to see how things go, maybe get a little bit extra monthly cash flow, and they have this financial security as the upfront payment or the deposit for the rent-to-own. So that's the nice thing about it, right? But then at the end of the day, if the tenants are buying out the property, you end up losing the asset after a few years, and maybe that's the downside, depending on how you want to invest and what your long-term goals are as an investor, because maybe you want to build a larger asset base over time and hold on to these properties. So if that's you as an investor, it might not be for you. We've seen some investors that love rental properties, and they've done them time and time again, and people buy out, they take the down payment, their initial down payment, they take the profit, and then they invest in 2 properties and they grow a portfolio that way. And we've seen some investors try, they're like, hey, it's not really for me. I don't want people to buy the asset. I want to plan to own these things for a long period of time, and I do planning according to that way. So it can work for some people, but it might not be right for some investors as well. So it's really up to them how it works for you. But ultimately, the goal of rent to own as an investor, in our opinion, is trying to create win-win scenarios. So you're trying to put a tenant or tenant buyer, as we refer to them, into the property that can ultimately qualify for the property and get into home ownership. That's their goal. You're helping them with that. You're catering to that top 20% of the rental market. You're creating a bridge for them, especially when in an environment where maybe mortgages are harder to come by, or just lending in general is harder. You can give them some options, or maybe they've been through personal circumstances where they can't qualify for a mortgage today, they're close, and you're able to kind of give them that extra boost. So that's nice. And then as an investor, you're able to then generate some profit from what you're doing for them as well. So it's not about squeezing every last dollar out of everyone or anything like that. It's about creating win-win scenarios that kind of work for everyone, and it can work really well in market conditions. And for us, the key for it is buying nice homes in nice areas. We'll cover that in another video, but the type of property we look for was specific, and I felt that really kind of contributed to the long-term success of these. But again, we'll dive into that another time. So if you have any questions around this or any other investment strategy, and you just want to talk to someone on our team, you can just book a call on this page. There'll be a QR code or a link someplace. You can just click on it and book a call with someone on our team, and they'll be happy to answer that stuff for you. So that's it for Rent to Own today. We'll talk to you next time.